everyone, and welcome to episode 6 of the Real Estate Rabbit Hole. I'm a co-host. My name is Michael McGuire. I'm with Remax Advantage. My number is 410-227-2483, and I've been a real estate agent for about 20 years. Our co-host is Dave Muir. Dave, please say hello.
Hey, Michael, how are you, pal? I know the weather outside is frightful. It happens to be December 2nd, 2025. I'm Dave Muir with Prime Lending. Been in it a few decades. I'm not even going to get into it, but let's just say 38 years. Number to reach me, 410-241-7908. Lots going on in the world right now in terms of lending, that's for sure. So hopefully we'll get... So it seems like increase your knowledge today.
In the real estate game overall, everybody wants to talk about mortgages and things like that, and of course recently there's been some hubbub over 50-year mortgages. Dave, what do you think of that, and what can you tell us about that?
We know when I heard this hype coming out of Washington D.C. a couple of weeks ago, and that's gonna maybe solve our housing issue for young people trying to buy a home and make it more affordable, I started to just run some numbers. And what folks first have to understand is that securities are priced according to returns for the investor and the guarantees of those returns or the assumed guarantees of those returns. So when a mortgage is longer term, 30 years, for example, versus 15, the guarantee of the return over a consistent period of time is less. And the reason I say that is 30-year mortgages are generally, historically, within a 7 to 10-year time frame, either refinanced or paid off, or a homeowner moves and pays it off. When we start to talk about longer term, even further longer than that, 40-year amortization, 50-year mortgages, the hype is, oh my God, I'm going to save so much money per month. Well, let me clue you in about how a mortgage of that duration may be priced. The investors for that kind of money, because it's not a very liquid market, are going to demand more interest on the front end, i.e., the pricing of those loans is going to be higher. So believe it or not, if money, and again, I'm just going to use a quick thumbnail here, a $500,000 mortgage at 6% on a 30-year basis, the payment is right at $3,000 a month, okay? $29.97 to be exact. 50-year mortgage, okay, priced at, oh my goodness, it's going to be at least 1% higher in the mortgage market because of what I just said. 7% will be a higher mortgage payment. Now think about that for a minute. Wait a minute, we're going to introduce 50-year mortgages with the idea being making the marketplace more affordable. Well, interest rate better be the same or real close, or guess what? The monthly carrying cost will not be lower. And when you run the numbers at what I think money would be at that kind of term, I think the market could be as much as 2% higher. And oh, by the way, if it's 2% higher for that loan amount, your mortgage payment will be $300 or $400 higher per month for a 50-year. So the hype is just not the reality.
And the only reason that in theory somebody would want to, take a loan that had more years on it would be if it actually was less per month.
Correct.
But
correct.
Even saying that, when you talk about the fact that people might sell the house in 10 years, and someone might say, well, for those 10 years, I'm going to, even if it was a lower payment, you're saying it might not be, but if it was a lower payment, in those 10 years, the equity that you build is going to be much less with a 50-year mortgage than it would be with a 30, or even a 15.
Less.
So what is the most common mortgage though, Dave?
Well, I mean, for years and years and years, and we're unique as a country in offering 30-year money. You know, countries around the world do not do this. We have for many, many years the securitization, the liquidity in the marketplace developed well over 50 years ago. And so therefore a 30-year mortgage is what people think of in their head when they're going to buy a home. So the most common borrowed term is 30 years, and therefore the liquidity in that marketplace is the greatest, and therefore there's more money traveling through the marketplace for those kind of terms. If I run the numbers, Mike, and this is just the other factoid that people don't really understand in thinking that the payments are going to be just so much lower on a 50-year loan. On a $500,000 loan, if the rates were the same as a 30-year, on a $500,000 loan, the mortgage payment's $365 a month lower. Now, that same client who comes in the door and says, "Wow, that $365 can allow me to buy the house I want to buy." So many times we see, and we've talked about this on previous episodes, we see additional debt. You know, the same client that comes in with a $500 or $600 auto loan. And I go, "What are you doing? You can afford the house you want if you shed the other debt." So these 50-year talks, it's just not going to play out anytime soon unless huge liquidity comes to that market. And investors, I will tell you, in mortgages also know this. To answer the question, what's the most common? Well, 30-year. Well, if somebody's going to take out a 50-year note, rates are higher. Reason they'll be higher is because the investors expect what we call an early payoff of that loan, an EPO. They know that they're not going to get that return very long. It won't be a 7 to 10 year window. It most likely will be 2 to 3 years at most, because the loan will be refinanced to, guess what? A 30-year term.
Is part of the issue also, like when you said something a minute ago, part of the issue, correct me if I'm wrong, but I would think part of the issue is that the market isn't even used to or have a lot of funds available for a 50-year mortgage, but they are very used to a 30-year mortgage because it is so common. They're used to a 20, a 15, like because of the comfort level that lenders have with those terms, because like you said, over the years, this is how it's been done, versus if someone just all of a sudden says, "Hey, let's do a 50-year," there's not people that know how that's going to work for
Correct. And the reality is that investors know that if someone's taking out a longer mortgage, 40 or 50 years, guess why they're doing it? They may be a greater risk than, and they will be viewed as a greater risk than the guy taking 30-year money. And that's why on the flip side, when you start to talk about shorter term amortizations, 20 years, 15 years, 10 years, that's why those rates are lower, because the investors know they're almost guaranteed their returns, because the history of delinquencies on shorter term mortgages is nil. It's nothing. When somebody takes out money for 20 years, 15 years, 10 years, the typical time frame is, believe it or not, an early payoff of 7 or 8 years, but the payment histories are perfect on those loans. So again, we get away from what's sensible in the market space, and 50-year terms are not going to be very helpful to those if the goal is to open up housing for more folks and to make homeownership more affordable. Longer term mortgages of 40 and 50 years are not the answer, because the rates on them will be higher and will offset the alleged benefit of getting in for lower carrying costs. There's another type of mortgage I want to mention too, but we'll talk about that here in a second. Go ahead.
Well, I think I was going to throw you a curveball here.
And that's fine. Go ahead and do that.
What I was going to ask you is when somebody comes to you who wants to buy a house, how do you determine or coach them through or figure out what is the best type of loan for that particular person? Like, what types of things are you looking for from the client?
I look at one of the questions I ask is, what's your risk tolerance? You know, where do you want to be in terms of financing this home? Looking at where, for example, where your equity position will be in 5 years, in 10 years, and looking at a shorter term loan versus a longer term loan, where that equity position will be. And all that means is, Mike, as you understand fully, a shorter term loan, 15 or 20 years, you're going to pay the thing down, just making your normal payment. You're going to pay the thing down much sooner, right? So 5 years out, you're going to have a much lower balance than you will on a 30-year term. But in terms of that conversation, we have to mutually decide if that shorter term mortgage payment is comfortable. They can make that decision along with me, obviously looking at what they qualify for. But really, we ask about priorities. Where do you want to be in 5 to 7 to 10 years? And it is a really important part of the decision-making process around what might best benefit, what might be best for that particular client. So many folks are only driven by, when they buy that first house, they only are driven by the mortgage payment. What's it going to be? I need it to fit into my budget. Obviously, you need to fit in your budget. We're going to make certain of that. But have you considered other options from the standpoint of a lower rate on a shorter term loan and where your numbers will be there? So I do have that discussion, but we look at the numbers on paper. And so many times, if they're buying their first, they want to back up to the 30. Others?
Well, and this is, you're kind of just talking about even the term, the number of years and how that's going to affect or be affecting the payment itself. But also there's other types of loans. And I guess I wanted to ask you how you decide, is a conventional loan the right loan? FHA, VA? Like, how do you help determine what might be good for one person and not good for somebody else?
What they're eligible for is an important part of the discussion as well. A veteran, someone who's active military, can go with a VA loan, which is the advantage, primary advantage, being 100% financing. They don't need a down payment. They're still going to cover closing, or the seller can pick up their closing. And literally, veterans or people who are active military or retired, honorable discharge folks, can get into a home for $0. They literally can, but they have to have been in the military. When we look at FHA, when we look at USDA, other types of government financing, less down payment, have to qualify for it. We look at credit scores and determine which way might be the best to go in some cases. And again, depends on the type of home, depends on the marketplace, what we see, what inventory they may be looking at can play a role. For instance, USDA has to be a rural property as determined by that agency, has to be in what's called a rural census tract. So, and we have maps that determine that. USDA is 100% financing also, but the house has to fit into that box. So again, there's so many ways to determine, as we sit down initially and analyze a client's finances, what might be the best route to take. In addition to, term of loan. There is much more to that. I know we were talking about 50-year money, but certainly that's just, again, I think it's early in that cycle, pie in the sky thinking, and rates aren't going to be the same. They're just not for that longer term amortization.
So basically, a consultation with the lender, with you, is going to help determine, the best type of loan, the best fit. And again, based on the property, based on the location, based on the amount of savings they may have, all that's going to come into play when you sort of work with someone to say, what is the best type of loan, in
Sure.
your case?
Absolutely. And we look at We do I call it the medical review, very similar to when you go see your doctor and they're giving you a health exam. Our exam is a financial exam. That's the analogy I like to use, but a friendly doctor, not one that. Anyway, if you follow what I'm saying, and I don't need to get into those kind of terms, but the reality is it's not as intimidating as the public may think if you're dealing with the right folks. So we approach it from, hey, income, assets, credit, three legs to the stool, and we determine what you can do. It's not as complex as the world makes it out to be. I think initially, because of the fact that the house is a major commitment financially, I think it creates that sense of, oh my God, what am I getting into? When the reality is, no, we make certain that it's comfortable for you. So again, I don't like to really use an analogy of a health exam, or let's put it this way. How about a health exam from a friendly doctor? Let's just put it that way.
So one of the other buzzwords that came up lately is is a mortgage that would be like portable, where you could take it with you, because so much of the market loves their mortgage, even if they want to change their houses, or they need to move up to something larger, or if they need to move to a different area. They'd love to take the mortgage they have with them because of the rate that they have. So what's the deal with a portable mortgage?
Well, the idea of a portable mortgage is simply that, and again, conceptually, it's just wonderful. And in English, it simply means that the money that you got in 2020 or 2021, because those are the years I want to specifically refer to, when money was being given away. And I want to stress that, given away. 2%, 2.5%, 3%, 3.5%. In those windows, anywhere from 2 to 3.5 is where generally people ended up with mortgage money in the window of 2020 and 2021. Unless they had horrific credit, they ended up somewhere between 2 and 3.5%. So the thinking now is that, gee, how do I keep this bucket of money with me when I move to the next house? Well, it's a little more complex, and there's many questions to it. And in essence, if you would go to sell your home and you have a large amount of equity, this is a little bit more complex. And here's what I mean. Let's say you owe $250,000 on a house and you're going to sell it for $600,000. Or let's say you want to sell it for, I don't know, $500,000. Okay, you got $250,000 of equity, right? And you want to move up. So you want to buy a $750,000 house and bring your $250,000 with you. Well, that's great. So we as the lender are going to be asking, okay, where's the other $500,000 coming from? Okay, well, some of it's coming from the house I just sold, my $250,000. That still leaves me a gap of $250,000, right? And do I have $250,000 to put down? Or do I have the 20% to put down? And in some cases, it just depends on how the numbers shift. But what some people are going to have to do, if that becomes a reality, is take out a second lien on the house they're going to buy. So most second mortgages are tied to the prime rate. Prime rate today is 7%. So you end up with a hybrid mortgage. You end up with your 2.5% money and then another balance of 7%. So are you really benefiting longer term with something like that as opposed to one new mortgage at 6%? Now, there can be arguments made, and we can run the numbers on somebody's situation. But I think, Mike, the only folks that really benefit from the theory of portable mortgages are those who are buying down, meaning those who are selling and up in years and buying a lower priced home. They're cutting their square footage. They're intentionally buying a lower priced property because those are folks that may not need a lot of money at all to do this and can transfer that mortgage. There's another rub with portable mortgages that I don't think has been addressed, and it's really important. And you run into clients like this, I'm sure. They want to sell their home, but they really haven't found the house they want to buy yet. But they sell their home. They go to closing on it. It's sold. Well, okay. They want to keep that mortgage. They want to keep that 2.5% Linus blanket, 3%, whatever. And they owe $300,000. Well, portable mortgage, what happens? Haven't bought the next house yet. Still going to make payments on it, right? So literally you're talking about a sector of the world that will have to make mortgage payments on a home they don't own. They don't own a property. They don't own it. They've sold it. They've sold the house. The lien has been released to the buyer. So the buyer's new mortgage is coming on to that home. But the seller's mortgage is technically not paid off as part of the sale.
Well, not paid off, and it's not attached to any property.
Correct.
The lender really has no way to go back and collect on that necessarily.
Correct. And guess what the terms of that mortgage are? The terms are you agreed on, May 1 of 2020 to pay the mortgage until May 1 of 2050. Well, you sell the house in May of 28. Guess what? You have 22 years left on that payment. It's going to have to be made. Oh, yeah. And you don't own anything. So I think we'll get a little squawking about that. I think we'll get a little bit of consternation from the American public. What do you mean I got to make a mortgage, but I don't own a house right now? Are you kidding me? Guess what? It's just a great concept. All these things that are talked about on a national level can be considered wonderful concepts. But the reality is, how do we do that? How did the title work on that house? We've got to release a mortgage from it, but we're not paying the lender off. But the lender still has a written contractual agreement to receive $4,000 a month. I'm just throwing out a what if. What if? Oh, but wait a minute. Whoa. The homeowner's insurance and taxes don't have to be paid any more on that mortgage. So now I just owe the P&I. Can you imagine what a servicing nightmare this is? That's not mentioned either. And so, oh, by the way, it's just, again, a conceptual mess in order to, I want to keep my ball. I know I'm going home. I know I'm leaving the game, but I'm a 5-year-old and I want to take my ball home too. Well, that's not always the way life works. And the reality is, if you have a 2.5% or 3 mortgage, that's great. And I love you for it. And I want to be invited to the mortgage burning party when you pay it off. But I'm not so sure you're going to be able to take it to a new address. That's just Dave Muir's thinking.
Well, it's like a lot of things that, somebody who maybe isn't in the business comes up with some grandiose idea, and there's a lot of different details, a lot of different tentacles that go out that make it much more difficult than just saying like, just take my mortgage with me.
Right.
And so the reality is that, usually with those difficulties and tentacles come charges and fees and other work that people have to do. And next thing you know, it's better just to pay it off and be finished with that and then move on to the next property.
Well, so, and again, to the point about, okay, somebody, most, not most, well, I'll say the majority of, and I don't know what the percentage is, but so many mortgages today have escrows, i.e. taxes and insurance are paid on that property as part of your mortgage payment. We call it PITI, principal and interest, taxes and insurance. Well, once you sell the home, you go to closing. Let's say you have your wonderful portable mortgage. Well, the T&I isn't owed by you anymore because taxes and insurance, you don't need to carry insurance on that house anymore. You don't own it. Taxes are now paid by the buyer, the new owner. So you technically would just owe P&I going forward. The servicing challenges of something like this to your point, Mike, and you just made it, i.e. cost, fees, you're going to pay more. In the end, there's fees that will have to be paid in order to cover a lot of servicing guarantees, etc.
Well, correct me if I'm wrong too, but I think most deed of trusts say when the house is sold, you have to pay off the mortgage.
Correct. Because the lien has to be cleared through the courthouse. Mm-hmm. And I think title attorneys would have a field day in this discussion as well. How do we have a clear title if we're not releasing the lien from the standpoint of the previous lender? What are we really doing? We're not paying it off because it's portable. It's an interesting legal discussion. There are a lot of Latin terms that I don't understand with this that were probably developed BC. And I can say to you, and I'm not that smart, but I know this. When you borrow money against a property, it's for a specific address, and it's for a specific period of time at a specific rate and a specific payback. Guess what? You may not own the house anymore, and it's just not going to go away. If you want it to be portable, again, if you want to take your ball and go home with your 2.5% ball, you want to go home, that's great, but guess what? Okay, you can okay, let's bring that $300,000 to the next house that you're buying up, right? But you really only cleared $200,000 from the other house. So it's an $800,000 house. So really, you're going to have a $300,000 first mortgage and a $300,000 second mortgage. So is your financial picture going to be better on the next house?
Well,
you follow me.
It sounds to me as if we're not really ready for the portable mortgage, Dave.
Thank you. Because the other definition would be, right, a better adjective for it would be hairball mortgage, because there's a lot of hair on that mess. And it's not something that people understand at all when they're throwing out the term. Would, any of us who borrowed money in 20 and 21 love to keep it? Certainly. Absolutely. They'd love to keep it. But guess what? It's called life. Life is tough sometimes. We can't, as we get older, have our cake and ice cream and eat both. And then, I don't know, take the cake with us. We've got to leave it with who we brought it to. I'm just saying, it's just a mess. So, and I think we made clear what the issues are on this kind of talk. I think we've covered both of these issues pretty well, Mike.
Yep. I think so as well. And we're going to close out episode 6 of the
Absolutely. And talk a little bit about what, in episode 7, I think we need to revert back to the real estate world. We're going to talk some about, sellers' expectations and what they still think they can get for a house. And Mike's going to be, Mike's got a few ideas. Am I right?
It's been interesting what's going on here lately, over the course of the last, I would say even the last half of this year, the way things have changed. And really real estate, in the 20 years I've been doing this, it almost never stays the same. So It's always ready to throw you a little curveball. And,
exactly.
And we will talk about that on the next episode, Dave. So
Absolutely.
I'm going to sign off on my end. Michael McGuire, Remax Advantage. Again, my phone number is 410-227-2483. And Dave?
Dave Muir, Prime Lending, 410-241-7908. Michael, as always, it's been a pleasure, and I can't wait for our next discussion, and I hope you've enjoyed listening out there in the world. Talk soon.
Thank you.
See ya.